Slide 5. After studying this module, we shall be able to understand decision making and the decision making process, understand precautions in decision making, calculate suitable sales mix or product mix, evaluate decisions about the discontinuation of a product, understand the problem of limiting factor, and understand whether to diversify or not.
Decision making is one of the most important functions of any manager, and cost is always a relevant factor in such decision making. It is the process of evaluating two or more alternatives resulting into a final choice. Managers are generally faced with decision making problems like what to produce, what to sell, what price to charge, which production method to use, whether to make or to buy a particular component, which selling price or distribution strategy is to be adopted, and whether to accept special orders at special prices or not.
Irrespective of its nature, every decision has two aspects, quantitative and qualitative. The qualitative aspects include factors like public image, social responsibilities, employee attitude, consumer reaction, etc. Management accounting is basically concerned with the quantitative factors of decision making. It deals with the relevant information such as costs, revenues, capital invested, etc., required to take a decision. As mentioned above, decision making is the process of selecting one out of several alternative courses of action available, and the choice is made on the basis of profitability or cost saving. In managerial decision making, only relevant information should be used by the managers in evaluating alternative courses of actions and taking the final decisions. Relevant information implies relevant costs and relevant revenues, which are useful to evaluate the alternatives. Cost is an important factor in decision making. The managers have to evaluate the cost of one option against the cost of another. However, it happens that some of the costs associated with the alternative may not be relevant for the decision to be made. In order to take a sound decision, the manager must be able to understand and distinguish between the relevant and irrelevant costs.
A relevant cost may be defined as the cost that is applicable to a particular decision situation, and it has a bearing on which alternative is selected by the manager of the business firm. The irrelevant cost in any case must be eliminated from the decision making process. That is, it will not have any impact while evaluating the alternative courses of actions. Relevant costs are expected future costs that will differ between the alternatives being considered in a decision-making situation. Any cost that can be eliminated completely or in part as a result of choosing one alternative over the another is a relevant.
On the other hand, cost that cannot be avoided irrespective of which alternative is chosen by the manager is irrelevant cost. These costs have low relevance to the future actions and therefore must be ignored in the decision process. Relevant costs are future costs that are expected to occur during the period covered by the decision. Costs that are identical for all alternatives have no impact on decisions and therefore must be ignored. Relevant or differential revenue is the amount of increase or decrease in revenue expected from a particular course of action as compared with the other alternatives. Relevant costs and relevant revenues are those current and future values that differ among the alternatives under consideration. These are not same in amount for all the alternatives under consideration. There are differences between the alternatives, and the amount of such differences are called differentials. Thus, relevant costs and revenues are also called differential costs and revenues. A differential analysis of relevant cost is always preferable to the complete analysis of all costs because of the following reasons. Differential analysis focuses only on those items that differ, thus providing a clearer picture of the impact of the decision. A differential analysis considers fewer items, making it easier and quicker. The overall decision-making process, also known as the decision model, involves a series of steps. These are: identify and define the problem, identify alternatives as possible solutions to the problem, collect relevant data, costs and benefits associated with each feasible alternative, identify costs and benefits or revenues as relevant or irrelevant, and eliminate the irrelevant costs and benefits revenues from consideration, identify to the extent possible non-financial advantages and disadvantages, also known as qualitative factors, about each feasible alternative, total the relevant costs and benefits or revenues for each alternative, select the alternative with the greatest overall benefits, that is, make the decision, implement or execute the decision, and evaluate the results of the decision made. Precautions in decision making. Relevant revenues and relevant costs are important variables in the decision making process. Managers must be careful about the four mistakes while taking a decision. These are: sunk costs. Sunk cost is the acquisition cost of an asset minus depreciation. Sunk costs are irrelevant in decision making. Unitized fixed costs. Unitized fixed cost is the cost that is incurred jointly for all the products manufactured by a firm. Such costs are generally divided by some activity measure and assigned to individual units of the product. But in decision-making analysis, it is better to include fixed cost in its total amount rather than as per unit cost. Allocated fixed costs. It is common to allocate fixed costs across divisions, departments, or product lines. It is possible that a particular product or department may appear unprofitable, but actually it does make a contribution towards covering fixed costs and generating profits. Therefore, before deciding to eliminate a department, it must be asked which cost will be avoided if a particular alternative is selected. A fixed cost that has been allocated to a particular department may continue even after a department has been eliminated. Opportunity costs. Opportunity costs are important while taking a correct decision. Therefore, the opportunity costs must be properly identified and included in the decision-making process. Let us now move on to discuss the different types of managerial decisions and understand the mechanism of making decisions under various situations and available alternatives with the help of a few examples. Let us begin with the determination of suitable sales mix.
Any business firm which manufactures more than one product generally faces a decision problem as to in what proportion the product should be manufactured and sold, that is, what should be the composition of its sales mix. In other words, the firm has to decide as to how much quantity of which product should be manufactured and sold. The CVP analysis techniques helps in determining the best sales mix of the firm. The best suitable sales mix is one which gives the firm the maximum contribution. Here, the contribution under various sales mix is computed and compared, and the sales mix which gives the maximum contribution is selected. Let us understand with the help of an example.
The information as shown here has been drawn from the cost records of Summer Limited, manufacturing parts P1 and P2. The company has an option to adopt any of the sales mix alternatives in the budget for the next period. These options are 250 units of P1 and 250 units of P2, 400 units of P2 only, 400 units of P1 and 100 units of P2, 150 units of P1 and 350 units of P2. Let us find out which of the stated alternative sales mix should be adopted by the company. Let us first work out the variable cost statement per unit for each product. After adding direct material, direct wages, and variable overheads, we arrive at the total variable costs for both the products such that TVC for P1 comes out to be 20,000 and 14,000 for P2. After subtracting this TVC from the selling price, we get the contribution of rupees 5,000 for P1 and rupees 6,000 for P2. Now that we have computed the relevant per unit data for both the products, let us evaluate each of the alternatives. For alternative 1, we have 250 units of P1 and 250 units of P2. We have contributions of rupees 12 lakh 50,000 and 15 lakh for P1 and P2 respectively. Now adding the contributions of both the products and subtracting the fixed overhead of 7 lakh 50,000, we get a profit of 20 lakhs. In the second alternative, we have 400 units of P2. We get the profit of rupees 16 lakhs 50,000 after subtracting the fixed cost from the contribution of 400 units of P2, that is 400 multiplied by 6,000, which equals 24 lakhs. Similarly, we can arrive at the profit figures for the third alternative, wherein we have 400 units of P1 and 100 units of P2. The contribution comes to be 26 lakhs, and after subtracting the fixed overheads of rupees 7 lakh 50,000, we get a profit of rupees 18 lakhs 50,000. And for the fourth alternative, where we have 150 units of P1 and 350 units of P2, we get a profit of rupees 21 lakhs as shown here. Since profits under the fourth alternative are the maximum, that is rupees 21 lakhs, and therefore out of the available sales mixes, the fourth one should be opted for by the firm.
Decision regarding discontinuation or addition of a product. The decision to eliminate an unprofitable product is a special case of profitability evaluation of the business firm. To evaluate the financial consequences of eliminating a product, it is necessary to concentrate on the differential or incremental profit effect of the decision. An important factor in the decision to drop or add a new product is whether it will increase or decrease the future income of the business firm. Appropriate cost and profit measures must be developed for each alternative. Care must be taken to consider not only the profitability of the product being analyzed but also to evaluate the extent to which the sales of the other products will be adversely affected when one product is removed. The unprofitable product may also be a complement to more profitable products, in which case some customers may buy the more profitable product because the unprofitable product is also available from the same company. If the expected sales decrease of the related product is severe enough, it probably would be desirable to retain the unprofitable product.
Management needs data that will permit the development of warning signals for products that may be in trouble. The following are some of the warning signals of an unprofitable product: increasing number of customer complaints, declining sales volume, decreasing market share, expected future sales and market potential not favorable, and return on investment below a minimum acceptable level. Variable cost approaching or exceeding revenue, variable cost consistently increasing as a percentage of sales, increasing percentage of executive time required, constant reduction in price to maintain the sales, and constantly increasing promotional budget to maintain sales.
Key factor. Key factor is also called limiting factor. Key factor is that factor which is most important for taking decision about profitability of a product. The extent of its influence must be assessed first so as to maximize the profits of the business firm. Generally, on the basis of contribution, the decision regarding the product mix is taken. But actually, it is not the maximization of total contribution that matters, but the contribution in terms of key factor that is to be compared for relative profitability. Thus, it is called the limiting factor or governing factor or principal budget factor. If sales can't exceed a given quantity, in that case, sales is the key factor. If production capacity is limited, contribution per unit, that is, contribution in terms of per unit of output, has to be compared. If raw material is in short supply, contribution has to be expressed in terms of per unit of raw material required. For example, if labor is in short supply, in such a case, contribution per labor hour is to be computed and compared. If machine capacity is a limited factor, in that case, contribution per machine hour is to be computed and compared for appropriate decision making. Thus, profitability can be measured by contribution per unit of output divided by number of units of the key factor required to produce 1 unit of the.
Let us consider an example for the same. Suppose a company manufactures and sells three products, P, Q, and R. All the three products are made from the same set of machines. Production is limited by machine capacity. The raw material cost per unit, direct labor cost per unit, other variable costs per unit, selling price per unit, and standard machine time required per unit has been given as shown here in the table. During the year, the company faces an extreme shortage of raw material. It is noted that 3 kg, 4 kg, and 5 kg of raw materials are required to produce 1 unit of P, Q, and R respectively. Let us find out how the product priorities change considering the key factor.
Now, in order to take a decision regarding priorities of the product, we first need to prepare a comparative statement of profitability for each product. The total variable cost, which is the sum total of direct material, direct labor and other variable cost, comes out to be Rs 305 for product P, Rs 420 for product Q and Rs 546 for product R. And the PV ratio, which is computed as contribution divided by selling price, comes out to be 39%, 30% and 22% for product P, Q and R respectively. Since we have to find out the priority of the products based on limiting factor, contribution would not be sufficient to make the decision. Here we need to find out the contribution per unit of the limiting factor we are considering. In this example, we consider two cases. One, when the capacity is limited by machine time and when the capacity is limited by raw material. When the capacity is limited by machine time, in that case, contribution per unit of standard machine time is to be computed by dividing contribution per unit by the standard machine time required per unit of output for each of the three products P, Q and R. It comes out to be Rs 5, 9 and 5.5 for product P, Q and R respectively. Similarly, the contribution per kg of raw material can be computed by dividing contribution per unit of output by number of units of raw material required to produce 1 unit for all the three products P, Q and R. It comes out to be 65, 45 and 31 for the three products P, Q and R respectively. With this, we are finally now in a situation to take our decision. If the machine time is considered as the limiting factor, the contribution per unit of standard machine time is to be considered to take the decision regarding the priorities of the product. And here we see that in that case, product Q is the most profitable, product R comes next and then product P is the last. And when raw material is considered as the limiting factor, In that case, looking at contribution per unit of the raw material required to produce 1 unit of the 3 products P, Q and R, we see that product P is the most profitable, product Q comes next, and then product R.
Diversification of production. A business firm tries to go for product diversification in the following cases: to utilize the idle capacity efficiently, to maintain the interest of the consumers in the products of the enterprise, and sometimes it becomes a compulsion because of competition, or to capture more market share.
The new product should be introduced only if it can add to the contribution of the business firm as a whole. It is preferable to undertake the production of the new product if it is capable of contributing something towards the fixed cost and profits after meeting the relevant cost of sales. Fixed costs are not to be considered on the premise that the new product can be manufactured in the existing resources without incurring any additional fixed cost. However, if it involves the increase of special or product specific cost, these should be deducted from the contribution per unit of the new product before making any decision.
Let us consider an example. The details for the product A1 manufactured by XYZ Limited are: sales rupees 5,50,000, variable cost 3,30,000, fixed overheads 1,50,000. The company proposes to introduce a new product A2 so that sales may be increased by 1,35,000. The production of this new product does not involve fixed cost, and the estimated variable cost is rupees 1,10,000. Let us find out whether the production of product A2 will be profitable or not. For making a decision, we first need to prepare profit statements in the current scenario, and when we decide to add A2 to our production, we will then compare the figures so arrived. First, we prepare the statement of profitability for product A1. After subtracting the VC from the sales amount, we get the contribution of rupees 3,30,000, and thereafter we subtract the fixed cost of 1,50,000 such that we get a profit of 70,000. Now we prepare the statement for the second case, that is, when we decide to produce A2 as well. The total contribution from both the products comes out to be rupees 2,45,000. Now, since there are no additional fixed costs involved, we shall subtract the same fixed cost, that is rupees 1,50,000, from the total contribution such that the total profit comes out to be 95,000 rupees. This analysis is on the basis of an assumption that idle capacity cannot be used for any other purpose except for producing product A2. As it can be clearly seen in our calculations, the production of product A2 will give an additional contribution of rupees 25,000 towards fixed cost and profit, and therefore it is advisable to undertake the production of A2.
Decision making is the process of selecting or choosing one alternative among various available alternatives. If there are no alternatives, there is no problem of decision making. Every decision has both qualitative as well as quantitative factors. In decision making process, the analysis part is based on quantitative factors only. The decision making process involves various steps like identifying the decision problem, finding out the available possible alternatives, analysis of all the possible alternatives, choosing the best alternative, keeping in mind the optimal use of scarce resources of the firm and maximum contribution to the firm. There are various managerial decision making problems like make or buy, shut down or continue, repair or replace, optimal product mix, or deciding about the optimal sales mix, etc. The decision regarding optimal product mix or sales mix is taken on the basis of contribution analysis and CVP analysis. In such decisions, fixed costs generally do not change whether particular product is reduced or increased. Therefore, the fixed costs are to be ignored. The product giving highest contribution should be produced to the maximum extent possible. In decision regarding discontinuation of the product, if the product is making contribution towards fixed cost, the production of the product should be continued. If selling price is more than the marginal cost, the loss will be minimized and thus the product should be continued. Key factor, which is also called limiting factor, is a factor which is in short supply to the business firm. In the case of key factor, the decisions are taken not on the basis of contribution per unit of output, but the decisions are taken on the basis of contribution per unit of the key factor. The product giving maximum contribution per unit of the key factor shows maximum utilization of the key factor and therefore it should be given priority in the decision process.